I'm here at Macquarie Street at the top of Martin Place, right where the Reserve Bank is located, the RBA. And you might be wondering, how does the Reserve Bank make its decisions? And is it really based upon some kind of a theory? Well, yes, it is based upon some kind of a theory, otherwise known as John Maynard Keynes or Keynesian Economics. And the Keynesian Economics in this day and age may appear to be a little bit outdated. A lot of the people who are making decisions at the Reserve Bank have been making decisions based upon an economic theory that is made somewhere around about 80 years ago. And John Maynard Keynes had penned a book and written a fair bit about how interest rates can control the economy and pricing and other different theories like that. However, do companies and do organisations really follow this theory when setting their own prices, and does this have any effect upon the pricing that we have for goods and services today? That is the question we're trying to answer in this segment. Now, why does it really matter what happens with the RBA's decision making? Well, a lot of it directly affects you and me. And half the time, I believe that the RBA is working on an outdated theory, which is known as Keynesian Economics, and something that's been around for several decades that may have well applied prior to the internet age. And certainly in the last 30 years, a lot of the things that we take for granted in the economy have changed gradually, and in some cases very dramatically over that time, especially in the last 10 years, that it's unrecognisable to what it was 80 years ago, when a lot of these theories originally came about and were documented back then. They certainly would have applied back then, because the economy of the world previously is very different then to today. In fact, what I believe is this, is that when the RBA does move up its interest rates, I believe that it affects the economy in a far more acutely different way than what it's ever done before, and in fact may even well be contributing directly to inflation itself. You see, one of the big things out there is at the moment is that a lot of the different CPI or Consumer Price Index items, there's quite a lot of items which are left directly out of, or maybe conveniently left directly out of, the CPI basket, such as rent. There's also other different things there which are left out conveniently, I suppose, and those things affect decisions of what people have or have not got left in their pay packet after they receive their income. And that affects their decision-making ability to buy stuff. I don't believe that large companies or government organisations listen to what happens with interest rates when they consider pricing their items that they sell or their services that they sell or market to the general public or to business. Essentially, it's this. They make their decisions based upon supply chain issues which are completely outside of the RBA scope, and also they've got to run a business too. They're not going to run their business at a loss just because the RBA thinks somehow or other magically that by putting up the interest rates that these people are going to drop their prices or not increase their prices. I believe that that is purely an anecdotal fantasy that the RBA has. And yes, the RBA has taken a pot shot at various different people in the finance industry by saying, well, don't tell us to do our job. Well, as the general public and in business, I believe we have the right to question what happens at the RBA. After all, they're an institution that are paid for by us, or maybe in their case, they can create their own money and pay for themselves, so they may not even need us. Kind of like a little island unto themselves. However, what they do does have some effect upon us, and I believe that leaving them too independent has probably let the cat out of the bag, and they can sort of do whatever they like. I think half the problem is this. Their decision-making is purely anecdotal, and unless they prove it to me otherwise, anecdotal decisions don't necessarily result in a proper scientific analysis of what's going on. And the assumption, and that is all it really is that by moving up the interest rates that somehow that's magically going to bring that down the consumer price index of the inflation and so forth like that, that it's going to have some effect there, that's fantasy too. Again, what evidence is there that they've got to prove that that really is the case? A lot of the large institutions don't necessarily follow what the RBA is doing in their decision making, and why should they? Let's take a quick look at where the 90-day bank bill futures rate is at the moment and what the forecast is based upon what the traders are actually doing in the 90-day bank bill area. I have had some experience with this, trading this in my much earlier formative years in my 20s, so I can speak with just a little bit of experience on what's happening today. However, currently what the situation is, if we look here at the September contract, it's currently trading close to the actual RBA situation at the moment. It's around about the 4.31 level. The December contract does show a decrease there. It's got here at 95.88, so it's at a little bit of an improvement there. The March contract and the June contract show a progressive jump here as well. So we got 96.15 and 96.32 just as an example. Similarly, again, we can say with the September contract looking out a year into the future. So overall, there is a prediction here that there will be, maybe say around about another 2 or 3 potential interest rate decreases, although the RBA does deny what's going on there. I'm just simply showing to you what's happening in the 90-day bank bill details, which you'll find on the ASX website. So you can check this out for yourself. So let me make this point perfectly clear. In today's economy, major businesses often set prices based upon factors such as global supply chains, market competition, internal cost structures, rather than the RBA's interest rate decisions. This could mean that interest rate hikes aimed at curbing inflation by reducing consumer demand might not be effective in controlling prices that are set by powerful multinational companies that are less sensitive to domestic interest rates. Furthermore, some experts suggest that the RBA's reliance on traditional economic models could be problematic, as these models may not accurately reflect the current economic realities. For instance, while the RBA aims to reduce inflation through higher interest rates, the persistence of inflation suggests that other factors such as supply chains, disruptions, labour market dynamics and corporate pricing power are at play and are less responsive to interest rate adjustments. So, there's an ongoing debate about whether the RBA's policies are too narrow and so forth like that, but I suggest there that they need to find another way to control interest rates if that is their objectives. Or why not just simply let it run a little bit, because I don't really believe that their interest rate scenario is working. Give us a break by lowering the interest rates so that we can breathe a little bit and let the economy have a little bit of fun for a while. I don't believe that half of the things that they're worried about are going to happen anyway, and they've got too tight a noose on their neck over the interest rate policy of 2 to 3% to make it worthwhile for the economy to withstand that kind of beating about by a brutal type of scenario. So that's my thoughts on the matter. This is David Newton speaking. Please like if you enjoyed this section. Please comment if you've got any thoughts on the matter. Make it respectful, of course. And I look forward to seeing you in the next few videos. There are some suggestions here of some other videos that I've got relevant to what you're watching now. This is David Newton speaking. Bye for now.